The real estate housing market crash is canceled? I know. The economy's in shambles, inflation, gas prices, Russia, interest rates, and I know the housing crash gurus have been calling for a housing crash for more than 2 years. But there's some new information that's coming out that tells us something that's completely different. So in this video, I'm going to give you the updated housing market report, and this is going to show you exactly what you need to be watching for and what you need to be doing, how it's going to affect you, and how you can use this information to make more money. And out of all that and more. Now, according to new data from Black Knight Financial, actual numbers from borrowers in some stage of delinquency from not making on-time mortgage payments has decreased 15.5% in March, dropping the national delinquency rate to only 2.84%. Now, this is according to the new data from Black Knight. The common misconception is that real estate is all the same, and it's not. Real estate is very geographic business, so just because one area crashes has no effect on real estate 1,000 miles away. So it's all about supply and demand. If this is your first time here, I just want to say welcome aboard. Our video channel is packed with info helping you avoid the pitfalls that are costly. So if you're ready, hit that inflation button and let's roll. Right now, we have two completely opposite things that are happening at the very same time in the nation. Inflation has shifted everything. Gas prices, food, housing, the dollar is dropping down in value. The hottest inflation that we've had in more than 4 decades has pushed prices of everyday necessities significantly higher, month after month after month. And at the very same time, we're seeing a continued lack of supply of housing month after month after month, and low unemployment. Companies are competing with one another for a limited number of employees. So how low will home prices go? Or should I say, how high should home prices go? I do see a couple problems here on the horizon, and I'm going to explain to you what you should be doing. Because if you're thinking about getting into real estate or getting out of the real estate market, watch this video all the way to the end so you're going to understand what to do and what to know. So right now, we're seeing some very low numbers of foreclosures. Remember, they told us we're going to see a massive wave of foreclosures. The truth? National delinquencies declined in the month of March. As an example, the average decrease in the last 20 years has been 10% in March, but this year's decrease was 15.5%, shattering the previous record set in January 2020. So fewer people are going into foreclosure? How is this even possible? With all this talk of recession and crash, they are obviously not paying attention to gas prices or inflation or Russia. Don't they know that interest rates are rising? Didn't they hear about the 50% off sale for real estate crash? Well, that's what the boy who cried wolf told us about anyway. The facts? Strong unemployment, continued student loan deferrals, strong post-forbearance performance, and millions of refinancing to low record rates have all helped put downward pressure on delinquency rates. Now, a surprising trend has really emerged here, and this is among those that are affected by foreclosure, which is totally the opposite of 2008. Today, they're faced with the prospect of losing their home. Remarkable thing is the fact that many of these individuals were able to sell their home quickly and actually put money in their pocket and manage to come out ahead financially. But the interest rates are rising and inflation is out of control. Even after last month's rise of such loans, the strongest improvement among borrowers with a single payment that has passed due or within 30-day delinquencies dropped another 20% from February. So with fewer homes going into foreclosure, what's going on? Serious delinquencies or mortgage loans that are more than 90 days past due and not in foreclosure, they actually fell 12% in March. This is one of the strongest one-month improvements in 20 years. Now, in some nations, this is contrast to what's actually going on. The economic impact in some nations, let's call it the recession, has already happened. So why in some parts of the world are feeling the economic impact so hard compared to the United States? And this continues to amaze a lot of experts, since the pricing of small homes to mid-size homes prices are not dropping. One reason, years ago, the government jumped in to fix the 2008 housing bubble, and they vowed it would never happen again. So this is what Fannie Mae website tells us. Better products, better credit. The mortgage system today is safer and sounder due to the changes in credit eligibility standards following the 2008 mortgage crisis. Now, Fannie Mae is one of the major primary providers of market liquidity for mortgages. They no longer purchase low or no credit documentation, negative amortization, interest-only single-family homes. They aren't doing this anymore. Nor are they taking single-family homes with prepayment penalties or even balloon payments. So the standards to help foster sustainable ownership while continuing to provide opportunities for credit-worthy borrowers and obtain financing to become homeowners. Now, the key measure of creditworthiness that Fannie Mae looks at loans today is significantly stronger than they were prior to that crisis. You know, the FICO score is the major score in the credit industry. So it's a strong predictor of mortgage delinquency as well. The average FICO's credit score for borrowers with mortgages in Fannie Mae in 2018 was 743. But check this out. The average FICO score in 2004 through 2007 was 717. So while FICO comparisons between two periods can be difficult due to the changes and underlying situations of the last decade, it is clear that general creditworthiness, I can't even talk, creditworthiness of today's borrowers is much better than it was 2004 to 2007. But this is interesting also. 91% of Fannie Mae's loans on the books were originated after the 2008 crisis. So this tells us the financial strength of the borrower today and the qualified ability to repay have formed guardrails on the mortgage lending standards that did not exist years ago. They didn't exist during the subprime mortgage crisis of 2008. Now remember here, it's all about supply and demand. This could be why Black Knight data was telling us that the foreclosure starts fell by 3% from February and are still significantly below pre-pandemic levels. Now, this ultimately means fewer homeowners are going to enter into foreclosures. But as the housing market returns to pre-pandemic norms, active foreclosure inventories and even the number of houses that are actually for sale continue to remain well below historical averages. So here's the bottom line. Will the housing market see interest rates increase? Yes. We're probably going to see higher interest rates multiple times this year and maybe even into next year. Will the housing market see continued affordability issues? Yes. It's called inflation. And just because you cross your arms and you wish things were going to be cheaper, like I Dream a Genie, and you blink your head and they go ahead and they become cheaper, it's not happening. The cost of everyday things keeps going up and up and up, just like they did during the Jimmy Carter inflation days. Now, during those times, interest rates went all the way up to 17.61%, and people are complaining about today's rates. Yet during that same period of the 1970s and 1980s, guess what? Home prices did not go down. Even with crazy high interest rates, home prices continue to rise year after year after year. So even in scary times, those that bought back then were very happy that they bought, and they did very well with their real estate purchase. Here's another thing. Is there a wave of foreclosures happening? Don't hold your breath. Based on the actual numbers, it looks like the exact opposite is happening. So no one knows what the future will bring. But one thing we can do is prepare for it the best that we can. So no matter what, smash that subscribe button for the YouTube algorithm. And of course, you want to be sure that you have an emergency fund set up so that you can cover your expenses for at least 3 to 6 months and take on only fixed rate debt if you're buying something on investments that you plan to hold for at least 7 to 10 years. Now, if you have long-term investment horizon, you're probably going to do fairly well. No matter what the economy throws our way, if you are smart, you're going to be good. So don't let the current news headlines scare you into making hasty decisions with your hard-earned money. With a little bit of planning, preparation, and following a tried and true investment strategy, you can weather the storm that comes, anything that happens and comes your way. So of course, this is advice that would apply to whether the economy is doing good or whether the economy is not. So I just want to say thank you for watching, and I'll see y'all in the next video. Take care, guys.